So Toast is it's a company we've talked about a few times here before, but maybe not in this level of detail. I seem to remember we did this as a quick almost every time we've covered it. But Toast is it's a comprehensive all-in-one solution designed specifically for the restaurant industry. It integrates sort of diverse functionalities like point of sale systems with payment processing, team management, payroll, training, that kind of thing. In terms of their Q4, revenue came in at 1.34 billion. That was versus 1.04 billion last year, so up about 29%. That beat expectations quite handily. EPS came in at 5 cents. It was actually 17 cents expected. It was a bit of a wild miss, but it was much better than the 7-cent loss from the same quarter last year. They did about 33 million in net income, Steve, versus 29 million loss the year before, so that was pretty good. And 134 million in free cash flow in the quarter versus 81 million same quarter last year. The key drivers of this revenue growth, Steve, addition of 28,000 new locations, contributing to a significant rise in gross payment volume, which is now up to about 42.2 billion. That's up about 25% from the prior year. Really underscoring this, how attractive this Toast platform is to this sector. In terms of ARR, which is annualized recurring run rate, that saw a robust year-over-year increase of 34%, reaching $1.6 billion. This metric is a real crucial one for subscription-based services. So if you come across this kind of company, this is one of the metrics that you really want to look at. It basically measures the sustained revenue expected from customers, and it's indicative of the company's long-term revenue stream. So think of it as a guide. Is essentially how I would think of it. In terms of recent business highlights, Steve, so Toast announced an expanded partnership with Uber Technologies, giving restaurants increased choice, gives their guests more food delivery options whilst helping restaurants reduce costs, expand their reach by leveraging Uber's extensive delivery network. In 2024, Toast partnered with about 1/3 of James Beard award-winning restaurants, which is just like the equivalent of a Michelin star or similar to a Michelin star. But they also partnered with over half of Michelin-rated US restaurants. So pretty impressive, really. And not just small people too, Steve. They've signed an agreement with the Hilton. They signed an agreement with Ascent Hospitality Management to implement Toast Enterprise Solutions at Perkins and Huddle House. It's going to be initially 500 locations, which is Toast's largest full-service restaurant group to date. They additionally signed deals with Mendocino Farms, a fast casual restaurant with about 70 locations in California, who look to Toast as a strategic partner to help them modernize the stores, the store operations, to streamline the staff training, and to support their future growth plans. The guide, Steve, was about 27 to 30% growth on the next quarter, but they think it'll taper to 23 to 25% year on year, which is still really strong. Off the back of these results, Morgan Stanley moved Toast into its top picks, Steve, for the year. I think I can agree with that, to be honest with you, but it's about 23 billion in market cap, so you've got to try and figure out what's left to grow into and beyond, Steve. Is it something that could hit your watch list?
Yeah, it's that last thing that you said, isn't it? Market cap here is high on this, but there's a lot to like. 23 billion is, in context of some other things, it's significantly big, but it's a nice combination of being quite specialized, but also with a sort of big market. So normally when I think about these kind of companies, they're not kind of generic. Well, at one end you have generic CRMs which have a massive market, so think Salesforce, and they're enormous and so on, but they can sometimes be a little bit flat-footed. They would obviously deny this, but sometimes they think you might not get the nuances of any particular industry. Down the other end, you have something like a Blackboard, which I've talked about occasionally on this, which is, roughly speaking, non-profits, so educations and charities and so on. They run things like Just Giving, which UK people might know about. That's obviously very much sensitive and well attuned to the needs of specific non-profits and the like, but doesn't have arguably the same kind of scale. Although, again, they will tell you they have plenty growth opportunities ahead. Both sides will deny this, but Toast is a kind of nice in the middle one here, right? So it's specific in that it's to do with restaurants, point of sale, that kind of thing, and their specific needs. It's also very, very broad in that the restaurant market is massive, and there's lots of room to run into here. And especially if you start factoring in, as you were saying, your Hiltons of this world, so things with huge numbers of outlets and big operations, and can sign big deals for them and fit them into count them in the market, and we start thinking the market is really quite large here. And they, as you point out, appear to have an appeal across the board. It's proper serious high-end Michelin restaurants that think they can help boost their service on this. Numbers wise, yes, revenue growth is high, and revenue growth, to be honest, needs to be quite high with this market cap at where it is and what they're currently managing in ARR. ARR is basically core sales for these guys. I'm not quite sure where else they get revenues from, but sometimes you see in some cases people have sort of hardware operations as well on top of this. But ARR at 1.6 billion, growing 34%. Yeah, needs to grow quite a bit. The rest of the numbers I wouldn't worry too much about right now, though what I would be mostly interested in is, can they keep signing up customers? Because the more they can sign up customers and find a big enough market to expand into, the rest of it will follow if they can get that bit right, because switching costs are high. If you can get Hilton stuck into your, and others that are out there, stuck into your kind of ecosystem, you're going to do pretty well, and there's going to be plenty of money in this for you. They're free cash positive, which is a good thing, because I'm always a bit wary when you're free cash negative. Profits are kind of minimal, but they're the right side of the line for the moment. And in general, I think this is kind of interesting. It's a big growth stock. It feels like it's an impressive growth stock by growth stock standards. And just priced like one at the moment, I think.
Yeah, I think that's fair enough, Steve. It's about 1,100 times earnings at the moment, but it's only really a recently profitable company, so it's kind of a nonsense metric to use at the moment. But it will be something people point to if you were to say to somebody, "I'm buying Toast because I think it's good value," they'd be like, 1,100 times earnings. That's ridiculous. But that will move at a rapid pace, I would imagine, especially with the sort of quality and quantity of things that they're signing up. But it's a tailored service, so they can only grow at the speed that they can tailor their service to the companies around. There is going to be limited amount of software hands to get this done. So there's going to be somewhat of a backlog. But I, like you, Steve, think it's a very impressive business, and I've just shuffled it to the top of my watch list to try and look around for a spot for it in my portfolio. Not against making that portfolio a little bit bigger when I can find some cash. I think it's a really high quality outfit, and I think I'm looking at a short-term valuation issue that will probably right itself over the coming period. I think it fits my portfolio quite well, Steve.
I think it fits your portfolio quite well. I have had an eye on something similar this week that's from the UK, different type, a different industry. We'll come back to this in a future episode. So I'm very much in the mindset of looking at ARRs at the moment and seeing ARR growth as positive, which is your kind of recurring revenues, or your expected sort of recurring revenues. And once you get people into subscriptions, you kind of trade off short-term value of stuff. So rather than selling perpetual licenses for big payday now, you basically sell a subscription for a smaller payday but repeated several times, hopefully to infinity. And that can look like, that can make your kind of price to whatever metrics go a bit funny for the bit. But you pointed out that it's something like 1,100 times earnings. Sure, if that thing grows at, you said revenue set to grow at, what did you have, between 23 and 25% for the year or so, you would expect operational leverage there. So call it, I'd expect to call it more than this, but call it 30% earnings growth for the moment. Okay, not 30% off that, and you come down to 700. You start knocking off big lumps when you get on these things. So, yeah, I'm not paying any attention to that PE ratio for the moment, but I think that's the right thing to do.
I mean, you've got 306 million of free cash flow to play with if you wanted to, if you wanted to see the the kind of growth levels that you're getting at the moment. Free cash flow the year before was just 93 million, so it's essentially trebled. And obviously that will go on in perpetuity, but expect growth in those profitability numbers to speed up, because well, not to speed up, sorry, but to be higher than the revenue growth numbers, just simply because this is one of those businesses that has operating leverage. It's got to the point now where it's tipped over into profitability, and it should continue.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.